Hemang, let's get in your sense as to what the outlook is when it comes to telecom, with the AGR dues hearing that is expected. What is your outlook?
So Telecom has been, one of the best performing sectors last 1 year, and the news flow continues to be on the positive side. And as you see, the case for a slightly better ARPU as we move into this year and next year, there is going to be, decent amount of earnings visibility that one can really factor in. The only thing is that, having seen such a big run up, whether people should really, get into the stocks at this point of time, we think that there is some more juice left in something like an Indus Tower, where the asset repricing story with the consolidation, with ARPU increase, is getting a bit stronger, and the valuations are still, more attractive. And I'm not going to be that comfortable chasing idea at this point. I am more comfortable buying into either Reliance or, for that matter, Bharti. So I think, these are the names that one can really participate even at this point of time.
Anga, I want to talk to you about these some of these dairy companies. Look at how Heritage Foods got a massive leg up and got re-rated over the last 2-3 months. But of course, it has a TDP angle to it as well. But Hatsun Agro, organically pretty decent numbers. These dairy, some of these dairy-based South Indian dairies companies are turning around in operations. Do you like any of them? Have you looked at this space?
Yeah, so from a tactical or a, let's say medium-term perspective, this space does offer, opportunities, particularly given the fact that despite the price increase that some of the, people have taken in terms of the milk prices, the results that some of these companies have delivered are pretty decent, and you're seeing, decent amount of growth when it comes to the top line. So, either Parag or Hatson, or Dodla for that matter, these are the companies where we have seen that performance. In fact, some of the companies are yet to deliver numbers. But I do think that if after the price increase, there is a meaningful improvement in the overall growth in terms of margins, then surely the market would relook at these companies, and there is a case for some more upside.
Your view on some of the buzzers within the broader universe yesterday. You saw a pretty smart technical breakout in Godfrey Phillips, for instance, and then there was also an MMTC that rallied about 7.8%. What's your view?
So Godfrey Phillips is interesting because the stock in the last 6 months or so, from end of December, the stock was almost at 2000 or 1800 levels. It's now climbed up to 4700 plus mark. So the last 6 months has been more of a major breakout for Godfrey Phillips, because then when you look at this in 2023, 2022, the stock used to be just stuck into a 200 to 50 pointer range, 1500 broadly as a support, and then 1800, 1850 as a resistance for the stock. So which means that this is a start of a major uptrend for the stock, ending months and previous years of consolidation for the stock. So the momentum looks to be quite strong. We could be looking at the fresh support, which is, or a base which is now at 4050 levels for Godfrey Phillips. So that's a stock which one could look to hold on even at current levels. MMTC, STC India, these stocks, they generally move into more of a price volume breakout every now and then. So we've seen these stocks breaking past above levels of, so for example, MMTC managed to break past about 98, 99 mark yesterday. Closed slightly below those levels from an intraday selling perspective. But I believe that the consistent attempt of these stocks to try and move up higher indicates that these stocks are still forming a pattern of higher highs and higher lows. So again, over here, we are looking at a fresh support which is closer to 86 mark for MMTC. Keeping that as a stop loss, traders could look at a buy.
Okay, fair enough. Meantime, Naresh, let me get in your thoughts then on, the infrastructure and real estate trade. Given that we do have the budget upcoming, and this will be a key area of focus from a technical standpoint, are there any stocks that one can look at to ride this theme?
So in that structural chart has been GMR Airports, which has continued in a good trend wherein it has made a move, then a consolidation, then a move. So that's been the structure from 50 to 65, then a pause, then from 65 to 90, then a pause. And now we broke out about 90, 95 levels, gone up to 100, and it's making a flag formation here. Now it's in a 5 rupee range. So if it crosses 102, 101 levels, that could be a fresh breakout. So that's a structural trend which looks promising as an infra play. where the trend has been positive and does not correct a lot in a correcting market, stays sideways. So I'll go with GMR Infra in that segment as such.
All right, there you have it. That's the view coming in on infra and real estate stocks. Meantime, HUL is certainly going to be in focus. Remember, they have sold their water purification business, Pureit, to A.O. Smith. Let's understand the contours of this deal, what exactly it means for HUL. Vinny, who tracks the company, joins in. Vinny.
Good morning. Yes, talking about HUL, they've sold their water purification business Pureit to A.O. Smith. Now, the sales that you look at it for Pureit in FY24 was at around 293 crores. And when you're looking at it at the valuation which they've sold, it's 2 times EV to sales valuation. Overall, they've sold it for a value of 600 crores. So, keeping an eye out on that, the EV to sales is 2 times. Now, other than that, when you're looking at it, Pureit as a part of HUL's business, the sales have only been less than 1% of overall HUL's turnover. The company has spoken about how they want to focus more on their core strategies, and this is in line with that expectation. So the management commentary also highlights that this is in line with the focus, the strategy to focus more on their core categories. What analysts believe that given the water purification business that's quite competitive, there is low product differentiation, and to be a price disruptor also it becomes quite tough in such a highly competitive market. So yes, what they believe that for HUL it is slight bit of a positive. UBS continues to maintain their rating. Nuvama said that they see marginal positive up move that is possible for HUL, as well as they are maintaining the buy rating for the stock. This transaction would be completed in a time period of 3 months, so keeping an eye on this one.
All right. That's the view coming in. Let's get in a quick chart check on HUL, given that we've spoken about the fundamentals and what this news could potentially mean for HUL. Kunal?
Well, I'm very bullish on the entire FMCG pack. HUL specifically also I think has done reasonably well. The stock started to move up higher by a margin of 15% at the start of the month of June. Post that 3 weeks of consolidation, the stock retraced back towards 2250, 2300 levels in terms of support. It was still trading much above its long-term moving averages. So when you look at this, the start of the month of June is where these stocks managed to give a breakout. Then there was a mild retracement coming back, these stocks coming back to their neckline. And now these stocks are coming back again towards a breakout mode, breaking past about the previous highs for HUL, 2600 levels. This also in complement with the other names, the likes of Britannia, Dabur, etc. These stocks are also showing signs of a similar price volume breakout. So I think it's a very strong trend in the making for many of these FMCG names. For HUL, I would look out for 2850 as a positional target for the stock.
Okay, in fact, Dalal Street continues to be roaring to record highs in tandem with the rest of the globe. But what is making the fund managers as well as investors bullish on the India story? Let's hear it out from Sandeep Tandon, who we interacted with yesterday, on why India is going to remain a constructive bet in the long term.
Risk appetite is equally constructive. For India, risk appetite surprisingly is still very constructive. It's actually inching up, where global risk appetite have slipped a bit. So India and certain emerging market risk appetite is still rising. Railway stock have performed very well. PSU has performed very well. Large infra call has done. We are very early talked about consumption thesis in January 2024. We launched a consumption fund. And we were 6 months early in terms of taking a call that something has changed. And we talked about in our presentation that rural economy is the cusp of inflection point. They're about to recoveries, early signs of recovery. High frequency data was showing early signs of recovery. And we took a very large bet on the consumption names. And look at our portfolio skew toward consumption, our FMCG in particular. It played out. So I think that is the strength of predictive analytics when we talk about, and that really help us in generating the superior alpha, which we have generated over 1 year, 3 years, 5 years sort of period. I think we remain very constructive about India as an equity asset class.
Let's connect with Hemang Jani. Hemang, what's your view on the market? Do you think the party is here to stay? Should one turn cautious or stay invested?
So Nikunj, a bit tricky situation given the way markets have run up, and when you look at valuations of the broader market, the way the QIPs are being launched, the way the IPOs are coming through, certainly one needs to be a little careful. At the same time, when the party is on, you don't want to be left out also. So I think you need to be a little nimble-footed about the flows, about the sector rotation. Should definitely participate wherever either there is a earning base, a movement that one is really looking at, or you're looking at purely tactical short-term momentum-based trading. But if I have to put incremental money into the market at these valuations, Nifty 22 times, mid cap and small cap stocks above 30, 35 times, that is certainly not comforting. Best case scenario is priced in, and now with Trump getting a little better possibility of being re-elected as president, and rate cut probably provide last sort of good news that we have. So overall short term positive, but not too comfortable in terms of putting incremental money.
What are your top 3 holdings which you think that you would like to own them? And if you're owning 2 stocks right now, are you confident of earnings or are you confident of momentum?
So, Nikunj, if you look at the market and the composition of Nifty, there are 3 pockets where still there is a valuation comfort, where there is a earnings, visibility also. First one being oil and gas, the city distribution gas companies. Also, some of the OMCs, this quarterly numbers may not be good, but at least there is a comfort if the crude prices come off a bit, that will provide you a lot of comfort. Banks is one space where you are seeing both valuation comfort and earnings profile also continues to look good. And to some extent, some of the consumer companies. So if you leave and metal companies. So if you leave aside these 3 or 4 sectors, the rest of the pack, be it PSUs, be it telecom, pharma, there is definitely a certain degree of stretch that one can call it. So I think one should really be looking at these 3 or 4 pockets.
Okay. Curious to get in your take, Hemang, on any of the recent listings that we've seen. Has there been anything that has caught your eye?
No, Avan, unfortunately have not looked at the recent listings per se, and my belief has been that by and large, most of the companies which are doing the IPOs, the valuations and the stories priced to perfection. You may see a little bit of move here and there, but not too big a fan of chasing these kind of companies at such a high valuations.
Right. Hemang, for a moment, I want to go back on that, water deal which just happened. I was looking at the Eureka Forbes is the only listed company which also has a, water purifier business into it. And Mr. Pota has been aggressively, trying to do a complete restructuring of the business and shared a very detailed presentation recently. Have you looked at Eureka Forbes recently?
No, Ajay, I haven't looked at Eureka Forbes, but maybe what you're saying is that in the listed space, there are not too many, competitive products, but that entire market, if you consider some of the, unlisted companies, there is enough, competition, enough, products which are available per se. And the overall size of the opportunity for the water, products is not that big. If you look at this Pureit itself, the top line that HUL was doing was hardly about 300 crore, So I don't think that by itself, the opportunity size is too large.
Right.
Okay, I just want to look at the rally in PSU banks yesterday. Very important and incrementally important. Is there a change of gear, Naresh? The fact that PSU banks are back and they all, hunt in a cluster from SBI to BOB, from Can Bank. Are we in for a good, smart 5-10% move in the entire PSU banking basket?
So that is what it looks like. So if you look at SBI, the stock on exit poll day actually had gapped up big time. It went up to 910 odd levels, then corrected back to 740. But compared to the rest of the market, there's been a very slow recovery. So most of the other large caps in the private banking space have crossed exit poll highs. The stock is still at 880. In the last 3-4 weeks, it was struggling around this 860, 870 mark, was not able to cross it meaningfully. Yesterday was the day where it actually gave a breakout move from a short-term range. And the next price is closer to 910. If that crosses, we get into a fresh momentum. So in this recovery, PSU banks, which were leaders in the previous 1 year, became laggards, and they've been still sideways. So it's just been a one-day move for some of the other banks. So SBI is still broken out of a range. But if you look at a Can Bank, it is at the same prices where it was in February. Uh, Still roughly around 10-12% lower than the highs made on exit poll day. So I would expect a recovery towards those levels. So in the names like SBI, it is just 4-5%, but in other cases, there could be a 10% move, possibly in a PNB, Can Bank, and Bank of Baroda going forward. And once they break out about those exit poll highs, then we get into a fresh momentum as well. So out here, the risk reward is very interesting to take a bet on PSU banks. The stop losses come around 2% and the upside to be 10-12% minimum case.
In fact, talking of PSUs, ONGC stands out. Yesterday, pre-market, we spoke about it, Kunal, remember, that it's reached a 10-year high. And after that, it ended at day's high, 5% higher. The 14-year high, I was looking at the data still, or the life high, is a 14-year high. It stands at close upwards of 400. Correct. Could it be going in that direction at least?
Yeah, I think many of the PSU stocks are headed to that kind of a direction. And, ONGC is a low beta stock relatively. So, with these stocks coming back into a 10-year kind of a breakout and ending that zone, where these stocks used to just get into a drag for themselves for months and for quarters and for years also, I think, on a trot. So I think these stocks have shown a very different kind of a perspective this time around. And the fact that ONGC scaled past above even the smaller hurdles, the 230, 250 resistance band, which was a major resistance for the stock for a period of time. Then 300 became a strong psychological resistance. The stock had a touch and go moment towards the 300 mark a few weeks back, and then now the stock has confirmed a breakout about those levels. So what we are looking out for is a phase by phase breakout and uptrend building up for ONGC. And I believe gradually the stock should be able to scale past about those levels of 400 also. Now the near-term targets, so we were discussing this last week also when I recommended 320 as a potential target for ONGC over the short term. I think after yesterday's move, we could be looking at an extension of another 20 points on the upside. So 340 could be a near-term target for the stock now.
Okay, meantime, this morning you've got some brokerage notes as well that are out. Varun Beverages, Morgan Stanley has an overweight rating talking about the expansion for their foods portfolio in Africa, and they believe that the gross margins as well are high compared to some of the other players. HDFC Life is on Goldman Sachs's radar. They maintained a buy and they've hiked the target price to 765 from 730, saying that the Q1 numbers have been in line with street expectations. While you've got a Vodafone Idea and Bharti Hexacon as well that is on the brokerage radar. JP Morgan has got an overweight on Bharti Hexacom, while Citi has maintained a buy on Vodafone Idea with a target price at 23. Just wondering, Hemang, what your outlook is when it comes to an HDFC Life and some of the other players within this space. Do you think that we will see the overall savings growth again, and therefore we will see overall ULIP products picking up?
Yeah, so I think from a sectoral rotation perspective, some of the life insurance companies are coming back in the vogue. And when you look at the numbers also, by and large, the numbers were in line. What I really liked about HDFC Life numbers is that the ULIP growth was pretty decent, led by bancassurance. And the VNB margins was also at 18%, which is reasonably good. And if you look at the APE growth for the first quarter, HDFC Life managed to grow at about 23-24%. So I think from that perspective, you might see some more stability and strength. And it's not a very high beta kind of a play. So one can really look at buying into some of these insurance companies for a 12-14% kind of an upside.
Okay. Meantime, just checking in on what some of the other stocks that were under pressure in yesterday's trading day within the frontliners, Asian Paints, and then by and large, some of those IT counters took it easy. What are you bracing yourself for when it comes to some of the other IT companies' earnings? Hemang, how have you read into HCL Technologies numbers, the kind of fiery trade that we've seen within IT? What's your outlook as to how one should approach the space?
I think, we have some positive takeaways from the IT numbers which have been out so far, particularly TCS, when it says that BFSI as a space is seeing green shoots and the order inflow has revived. The hiring position has gotten better. Even HCL Tech, for that matter, the numbers were not the best in the lot, but a little better compared to market expectations. And what is heartening to note is that some of these companies are looking at a decent growth when it comes to, let's say, next few quarters or year. What I feel is that, valuation wise, there is not much of a scope. When I look at HCL Tech, it is at 25 times, 25 earnings. The best case earning growth that one is really looking at is about 7 to 8%. So while because of the rotation change, because of the slightly better earnings profile, there is certain degree of interest. But it is not as if that things are going to be great, in terms of earnings growth. Uh, it's better to be selective. So TCS is something that we've been liking, and some of the mid-cap companies also one can really focus on if there is a meaningful correction.
We'll go back to, there's so much to choose from actually, that is it time to look at the other side of the fence, which is IT, defense, or is it all about staying with where the puck is moving, which is that where the momentum is moving, defense, railways, defense, railways. You are not running out of breath, and these stocks are not running out of momentum. 96% higher for HAL this year. Hemang, let's look at these businesses independently, right? I mean, what is the future of these businesses? Great in terms of top line, great in terms of growth, great in terms of government commitment, great in terms of the size of the pie. But what about margins? What about return ratios? What about equity return on equity? How does that measure for the defense sector?
So Nikunj, when we look at some of these PSUs, be it defense or railways, you cannot at this point justify these valuations, this market cap on any fundamental parameters. Whether you look at the P ratio, whether you look at market cap to sales, or you look at any other return ratio, the only thing that one can really think of is that you have enough and more, government support, order inflow, and more PMSs and AIFs are getting funds because of their performance in last about, let's say, 12 months or so. So I consider this purely as a momentum play, and maybe it will last up to whatever it has to last, because we never thought maybe 1 year back that some of the PSU stocks can go up by 10, 15, 20, 30 times. So the momentum can surprise you for a bit extended period of time. But I'm not a great fan of buying into these themes at these valuations.
Okay. I'm just going to shift gears and talk about another stock which has been in extreme momentum, and that is Zomato. The market cap of Zomato now stands at north of 2 lakh crore. And the market cap of Zomato at its low, when it was 40 rupees, you just need to divide it almost by 8 times. From $5 billion, it has gone up to now, what's the market cap, Ajay? Let's look at it, $30 billion?
Zomato is trading at right now
2.5 lakh crore, right? 30 billion.
Around that.
$30 billion. Hemang, what is the justification for $30 billion of market cap for Zomato?
So typically, when you look at platform companies, Nikunj, the good part for any company would be that once you reach a critical client size activity level, any incremental price hike that you may take would, significantly improve your operating matrices. So in case of Zomato, last about, let's say, 3 quarters, we've seen that happening. And with Blinkit, the way they have really shaped up that business, the way it has got the traction, I think it is adding more value to the overall valuations of Zomato. And I do think that, in a market like India, where you have, let's say, 2 major players, or maybe if you consider some of the, other guys who may come in eventually, at best 3 players, the size of the opportunity is big and they have already reached critical numbers. So I do think that valuation wise, a bit difficult to justify. But operating leverage can kick in a big way, earnings can kick in a big way, and fund managers would love that, investors would love that.
PFC, REC, let's look at those stocks. And for me, if I look at PSUs and I take banks aside, on the election day verdict, it appeared that the bottom has been broken for some of the PSU stocks. And they were supposed to go down by 10 to 15%. But where they are significantly higher from what the budget day lows were. PFC, REC, and I remember in 2019-20, they had gone below book and nobody liked them. They were called as the ultimate ugly ducklings in the market. if a PSU stock today goes public, and the last one which went public I think was IRDA, look at the phenomenal response it has had. And that's what markets are. Markets, they follow a cycle. There's a time when TMT stocks, when they were going public, and irrespective of whether the company was good or bad, as long as it was an IT, it had a gap up listing of some crazy 3 or 4x. I can guarantee that today if a PSU business goes public, it will just have a gap up start, and it will really be the darling of the market. That is how markets move. They are like a pendulum. Extreme fear, extreme greed. You have to balance somewhere in between. And I think the balance somewhere in between lies with private banks. The balance somewhere in between lies with some of the consumer names. The balance somewhere in between, I think, is with, I would say, good old consumer discretionary and some staple names. Next 6 months, the government will focus on rural India. The world will focus on US elections. Monsoons are expected to be good. Things are turning around. Things have turned around for autos. Things have turned around for two-wheelers. Things have turned around for a lot of rural-facing businesses. So luxury and niche consumption, and if urban spending was the buzzword for 2022-23 and first half of 24, it could be rural recovery, come back by the rural consumer, a stability in low-cost housing, and demand coming back in that end of the market really could be different. So what you need to do is that if you are standing on the pitch, and if there are two sides to look at it, which is right and left, I think it's time to don't leave the pitch, but it's time to look on the other side. My only thing is that right now, just imagine a cricket pitch, Ajay, onside and offside, right? And imagine if all the fielding side is on one side of the pitch. Then it's difficult to make runs. It becomes it's difficult to find gaps if you're a batsman. So imagine you're a batsman. Just think about it. You need to hit on the other side because there's no one on the other side. So if you hit on the offside, the chances of getting 1, 2s and 4s and 6s are very high.
Much higher.
So that is what I'm saying. That you don't leave the pitch. But if 9 players are on one side of the pitch, then you'll have to hit a 6, which is risky. Or you'll have to make your 1s and 2s, which is difficult.
Play the reverse sweep.
You'll have to do something. You don't leave the market, but look the other side. Similarly,
large caps.
REC PFC in 2019, they were trading sub-book. Today, IDA is trading 10 times book. One of the most premium companies which has commanded
higher
10
than
times
Bajaj
book.
Finance. What a lender higher than Bajaj Finance?
So, Bajaj Finance has also diluted equity. So, Bajaj Finance P multiple or price to book never went 8-9 times, right? The ultimate price to book story in India was always Graho Finance. Why? Because Graho Finance never diluted. And if you're not diluting, your price to book never goes higher. Right? Price to book. IDA is almost equivalent to what Graho Finance was commanding at its peak.
It's getting very
I just want to pause there. I'm not giving any judgment. All I'm saying is that imagine a pitch. Imagine a pitch. On the onside, 9 fielders are there. Can you sneak out your 4s and 2s? The answer is difficult. On the offside, which are a lot of new themes, it's a clear field.
In fact, one stock I want to discuss, Nikunj. Yesterday, the results for Angel One actually are very good. Today, everybody is watching out for the investor call because more than the results, people want to understand if there is any action on the F&O side, what will happen to their volumes, because right now they're deriving bulk of their volumes from the option side. Will they be able to meaningfully make up for it in some other way? Analysts have given their verdict, 20-25% of PBT could be at risk. The stock is back about 2,300 after making a low of 2,100 just a week back. Hemang, you understand this?
You are assuming that options, see Ajay, price and performance are two things which always drive demand, right? Equity market is the only place where higher the price is, higher the demand is, right? Today in the options market, if the market is going higher, I think even if you increase taxes and even if you increase STT and you make it difficult for anybody to go on easy on leverage trade, people will find their way because there is a proposition of profit. When STT came, we thought it would be dearth of liquidity. When long term came, when the taxes were increased, we thought that, okay, this bull market in equities is going to end. What happened? 2018, you paused. 2019, you paused. But then the rural bull market has come back. If there is option to make money, markets are like water. And flows are like water. They always find the way. As long as the turf is okay, there is proposition to make money, you'll always find things. That's my limited point here. So what options in the F&O market will not be shut down. you will make it incrementally difficult, and the cost of transaction is what the government can control. Cost of transaction, the tax payout. Cost of transaction goes higher. But will volumes come down? No, because there is option, there is proposition to make money. So you may see a drop. You may see dilution in terms of return for the investor or for the trader here. But that does not mean the exchange will suffer.
Yeah. In fact, these guys are betting on newer businesses. They've just founded a new business under Angel One called Angel Wealth, and they're trying to diversify their revenue mix as well. Hemang, can we have a quick call before we let you go on Angel One? You understand this business very well, but from 3,800 odd, it's at 2,200 in a year's time.
So very pertinent point, Ajay. I'll take a couple of minutes to explain this. One is that for discount brokers, a large part, 85% of the revenue is coming from F&O. So the recent recommendations given by the expert panel, of course, these are preliminary recommendations. The final, take will be done by SEBI eventually. But my initial understanding is that the retail clients or the bottom quartile does not contribute more than 2 or 3% of the total business. So the revenue impact may not be big. But what we need, clarity on is that per exchange, one weekly expiry is something that is not very clear, because at the moment you have, 3 or 4 indices from NSE and 2 indices from BSE, which are part of the weekly expiry. So whether we are going to have, let's say NSE confining to 1 expiry, or for Nifty, Bank Nifty, Fin Nifty, and Midcap, you'll have 4. So that is something that we need to kind of keep in mind. One interesting takeaway from my analysis is that if the final recommendation is that you will have per exchange 1 expiry, then BSE can emerge as a big winner, because currently the BSE's market share is hardly about 7 to 8%. 92% is with NSE. But if there is a rule wherein they say that there is going to be only 1 expiry, then that can be a game changer and a big positive for BSE.
All right, Hemang, we'll let you go on that note. Thanks so much for joining in.
If you like this video, then like, share and subscribe to ET Now.